It's Friday afternoon in Sydney. This is Friday Beers with Marc and Stuart. I'm Marc Kennis.
I'm Stuart Roberts.
And we're the founders of Pitch Research, Australia's leading provider of independent research. So Stuart, we published two reports this week and last week, one on Anatara Life Sciences and one on antiodiagnostics.
Yes. So Anatara Life Sciences last week, we published it at 38. The stock's since gone to 60. So the market's really responded well to that, report. Yeah. The big theme now is taking the same bromelain fractions, adding a few other parts to what could be a decent dietary supplement, and then going after some large human health opportunities in irritable bowel syndrome and various other gut health type problems down the track.
Well, the report is on our website, so have a look.
Yes.
The other one, antiodiagnostics?
Yes. Antiodiagnostics. This company is a world leader in what's called surface technology. So shuffled around various chemicals to create different kinds of surfaces. The big theme here is the potential to actually change the properties of silicon, so it could be useful in the anodes and cathodes of lithium-ion batteries. So very interesting take on the future of electric batteries.
On the topic of technology, we had a look at the best performance on the ASX in the last 12 months, and not entirely surprising, a lot of them were tech companies.
Right. This says to me that the market is getting smarter at your health, sir, at valuing tech companies on the ASX. Your conviction ever since you arrived in Australia is that Australia could potentially be a tech hub on par with Silicon Valley and the other major tech kind of areas.
Well, there's a lot of small cap technology stocks out there. Investors' understanding of technology stocks and how to invest in them is a bit different still. So there's a big sort of difference between Europe and the US on the one hand, and Australia, and how they approach investing in technology on the other. So my take on this is investors basically regard technology stocks in Australia, that is, regard technology stocks as mining stocks. You raise some capital, drill a few holes in the ground, and it's something's there or not. It's very binary, and so they treat technology stocks in a similar way. And of course, that doesn't work like that for technology. You need a bit more time, on the development side, and to let it play out. It's very unlike resources, I'd say. But that's my take on how technology is sort of regarded from an investment point of view. But just looking at some of these stocks,
consider this. This is four companies in the five in the top 200. The 12-month performance as of yesterday. Afterpay Touch up 199%, Appen up 160, WiseTech Global 116, Bravura Solution 116, and then a relative lag at a mere 70% return is Altium. Now, that says to me that investors are getting a lot more sophisticated than possibly they were even 5 years ago, in terms of capitalizing some of the more mature tech companies that have originated in our market.
I think you're right. And the key for tech companies is they need to get across this sort of hurdle where they become institutional grade. And whatever that is, it could be turning profitable or above a certain market cap. But until they do, it's a real big struggle for them, and they need a few sort of core shareholders, cornerstone shareholders that believe in the story to get them to that level where they could potentially be the next Appen or whatever, Afterpay Touch.
And would you say then that the success of those companies will ultimately change people's attitudes towards the emerging tech companies?
I hope so. Certainly hope so, because there's a lot of really interesting companies out there. But they're struggling to get across that hurdle to become sort of institutional grade. But the success of the large cap should hopefully free up some help the smaller ones progress to that level as well. So I guess the conclusion here is there's still hope for small cap technology stocks.
Right. Now, Marc, changing the subject, you and I have spent a lot of time over the last 2 years talking about MiFID 2, and what that means for our industry, and by extension the kind of work that you and I have been doing. Talk to us about what MiFID 2 is, what it means for equity research.
Yeah, sure. So MiFID 2, it's the second iteration basically of MiFID. MiFID 1, of course, been implemented.
This is not the John Wyndham novel Day of the MiFIDs we had to study at school, right?
Yeah, Day of the Triffids. This is a decade of the MiFIDs. I think because to just illustrate the extent of the impact of it, it's huge for the investment industry. But basically, what it means is that
this is a European directive for the investment banking system over there.
Exactly.
Right? Okay.
Yeah. And it means basically that in the buy side, so fund managers need to break out all the cost items when trading stocks. Right. So it used to be that there's one price. The commission paid to a broker would include all the costs related to corporate access, research, trading. Everything was sort of packaged into one price.
Basically, the privilege to call up and schmooze with your broker was all packaged into the price.
Yeah, and to do the trades and to receive the research, all of that. MiFID 2 states, need to break all that out, which means that all of a sudden research costs for the fund managers are very visible, right? And for their clients. And if it's very visible, you know exactly what you're paying to broker XYZ for specific research access.
Right.
And imagine, this right now I think 20 analysts on Telstra in Australia.
Yep.
I don't expect all of them to add sort of an equal value or even add value at all. Not all of them at least.
Right.
So fund managers might be able to do with just 5 analysts providing them with research on Telstra. So what MiFID is sort of forcing fund managers to do in Europe, that is, at this stage, is to sort of cut down on the number of brokers they use.
Right.
Because they need to pay all of them, and obviously that's too expensive.
Yes.
If all the costs are broken out. So what we're seeing in Europe is a huge sort of consolidation. Brokers are going out of business. The number of analysts are going down. There's a lot less coverage on mid and small cap companies.
Right.
It's European legislation right now, but it's also sort of moving over to the US. Wellington, Invesco, T. Rowe Price have started lobbying with the SEC in the US to maybe see if they can have some sort of legislation comparable to MiFID 2 in the US.
Right.
In other words, we're seeing it now in Europe. It's sort of trickling over to other jurisdictions as well. But if the SEC comes up with this sort of regulation, or sort of from
so what's in it for the buy side? I mean, aren't they reducing the flow of research that would inform their thinking by doing this?
Yes, it is. So for the buy side, the costs would be lower.
Okay.
At the same time, if you get less research from brokers, your sort of ID creation process will take a hit,
right?
Because you get fewer ideas from analysts. But overall, the costs should be lower. They're taking a lot of the costs on their own balance sheet, on their own P&L, I should say. So there's a lot more transparency. But the bottom line for companies, small and mid-cap companies, is there's a lot less research out on you.
Okay.
And going forward, we expect this to happen in Australia as well. So if you're a small and mid-cap company listed on the ASX and you've got maybe coverage from 4 brokers right now, expect that number to go down.
Right.
And then maybe down to 0 at some point, depending on how sort of fast this is implemented in Australia. In any case, we think we're part of the solution. So if you're a small and mid-cap company and you want to get some research coverage, give us a call. Who you gonna call?
So, Marc, I'm hearing from my friends in the entertainment industry that this whole MiFID thing is becoming so interesting that they're actually making a movie about it.
Are they?
It's admittedly it's a bit racy. It's called Debbie Does the Sell Side.
And then turning to this one, I like this one an awful lot. So this is IPA from Gage Road Brewing,
right?
And I think you know all about this one.
Yeah. So you had it at a function recently and found it quite good drinking.
I liked it,
yeah. So
as opposed to that sludge from last week.
Now, what I like about this, Gage Roads has a policy of not disclosing what hops are in their beer. So you've got to be a bit of an aficionado to guess. Since it's an IPA, it's probably an English hop, like Fuggles or East Kent Golding. You can tell because it's got a spicy kind of flavour to it. So my guess is that would be.
But the I is for India, right?
India. So the reason it's called India Pale Ale is these were beers that were designed to survive the journey from England to India. And the presumption was if you hopped them up enough, they'd get to India in much better shape. So that's how we get the term IPA. What's pleasing about this one is the IBU is very high, so it's 55. It's hard to get beers much higher than that on the hop scale, and obviously you and I have similar taste in. We liked hopped up beer.
Absolutely.
So that works.
Like my
well.
girls hopped up, and my beers hopped up.
What I like about Gage Roads as well is they're not shy at producing a full strength beer. So this is 5.4% on the alcohol by volume.
Yeah, really good.
So hopped up as well. So well done to our friends over in the West, and we look forward to more from where that came from. Here's to investors having a good week, and here's to MiFID 2 spreading around the world.
I'll drink to that.